Over the last week, we've actually seen the markets perform fairly well unless you're someone who is heavily invested in the Mag 7. As we can see, the majority of them, bar Apple, have been hit and fairly heavily, and Amazon, which is under the spotlight in today's episode, was down nearly 5%. However, what is quite interesting to note, as the Mag 7 continue to fall further and further, they are now at some of their lowest levels that we have seen in more than 2 years. But remember, with tariffs, something we're going to touch upon today, they will potentially affect their guidance, and therefore some of these valuations will in fact change. It's also nice to see that investor sentiment is getting a little bit better. Just a few weeks ago, we were sitting in the low single digit, nonetheless still in extreme fear, and perhaps over the coming weeks we may move into fear and even neutral. But one thing that is for certain, the market as a whole year to date in 2025 has not been one of the best that we have seen, at least in recent memory. We've got many companies that are not just down but quite significantly, quite heavily. Tesla alone is down 40%, and the others in the Mag 7 have seen a large amount of their market cap wiped off, with Amazon, as we said, under the spotlight today, down 21% in just 2025 alone. We're only a few months into the year as well, and they've seen more than 1/5 of their market cap just wiped straight off. Now, as we said, this company is under the spotlight. We want to understand, with the ongoing tariff tensions, is this a company that looks to be undervalued? Do we see it as a buy? What is our own interpretation, as well as what is our price target? Straight away though, Wall Street and Quant give this company a strong buy, and Seeking Alpha also give it a buy, so we can see a lot of bullish sentiment by analysts, and the company does trade near its 52-week low. Quite a bit of a pullback now from its all-time highs at $243, and the valuation is something we're going to touch upon shortly. But if you like to use the forward PE, it does sit around 27-28. Doesn't currently pay a dividend, unlike some of the Mag 7, which did just over the last year initiate one. We're talking Google, we're talking Meta, and over the last 12 months it is down around 5%. Year to date, as we highlighted, 1/5 of their market cap wiped off. But over the last 10, if you've been a longer shareholder, you would have massively outperformed the S&P, something we'll highlight later on, up 676%. Now, the first thing that we do want to highlight, this company is the cheapest it has been valued at over the last 10 years. Now, we are using the EV to EBIT multiple, and this one essentially compares the company's EV, which is the enterprise value, basically what it would cost to buy the entire company, including their debt, to their EBIT, the earnings before interest tax, which shows the company's core operating profits. And the reason why we use this for a company like Amazon as opposed to maybe the PE is because Amazon reinvests most of its profits into growth, and this multiple focuses on actual operating earnings, stripping out the interest, taxes, and non-cash expenses, giving us a cleaner view of how the core business is performing, and useful for companies with big investments and fast growth. As we said, trading at the lowest base on this multiple over the last 10 years. And if we were to look at the EV to EBITDA, very similar, but EBITDA also incorporating depreciation, amortization. It's not only trading at the cheapest over the last 10 years, but it now solely on this multiple is trading cheaper than the S&P 500. One thing we would say though, just because a company can be seen as cheap, it doesn't mean it won't fall further, just something we like to incorporate into our own investment thesis. And for those that perhaps do want to take a look at other valuation metrics, for example, as we said, on a forward PE trading at 27, that is above the sector median at 14, so you are in essence paying a 98% premium, but we do believe Amazon deserves a premium. We're going to discuss that as well, but remember, we also want to understand how much of a premium does it truly deserve, something we will cover in the episode. And if you look at over the last 5 years, on a P multiple, they have traded at 178, meaning right now it is 85% cheaper. And as we did just cover the EV to EBIT as well as the EV to EBITDA metric, we can show you on a forward basis on the EBITDA metric, 11.4. It is in fact above the sector, so you are paying a 29% premium, but in comparison to their own 5-year, they're trading 42% lower, and the same to be said on the EV to EBIT moving forwards. They are trading 82% above the sector comparison. However, when we look at their own 5 years, they are trading 61% cheaper, something that we notice regardless of any metric you look at for Amazon, they are trading at a lot lower value than what they have done on a historical basis. Now, the other thing we want to point out with a lot of these tariffs, a lot of these tensions geopolitically, this is just one analyst of many that have started to cut their price target on Amazon. Now, this one that we are looking at, they've dropped it to $240, which does still show a lot of growth even after all of these issues that are in place. And that is one thing we do want to consider today. Are we seeing a lot of these issues already baked into the price? Has it been suppressed to a level where now it looks like it is giving us an attractive starting value? Now, probably no surprises to hear that the CEO in fact himself said that he anticipates Amazon prices to increase because of these tariffs. And you need to remember, when there's any issues with tariffs, essentially the price of a product has to increase. There are potentially two things that a company could do. It could either increase their prices, pass it on to the consumer, where the consumer will either A, take on that additional cost, or they'll move to a cheaper alternative, which will mean for the company lower revenue, or in fact the company itself will absorb these additional tariff costs, and yes, the consumer will still buy their products, but for the company itself, their bottom line, their margins will suffer. So these are things we need to consider, but the conclusion here is very obvious that prices overall are going to increase. It will be very surprising to see if any companies actually absorb those costs. And some of the things that are being discussed, although this does seem a little far-fetched, is that there could be an end to trade between the US and China. One thing we do know at the moment though, it is very volatile, very dangerous, and nothing is off the table. And just bear in mind, at this point in time, although things do change very quickly, the tariffs that have been put in place on China and their exports currently sits at 145%. Now, we do understand that these tariffs are also in place on the US for their exports at 125%. But one thing we do know, a lot of products that are sold on Amazon do directly come from China, and that is something we can back up with some evidence. In fact, 71% of items that are sold on Amazon are coming from China, so you can already see how the effect of this is going to be very large. As we said, either consumers will stop buying products or to a smaller degree, or in fact moving to competition, or we will see companies affect their margins, and ultimately this will hurt Amazon one way or another. And quite interestingly, from just a few days ago, we are seeing here that Amazon are reportedly penalizing sellers for raising their prices, so something to consider, as sellers are now trying to increase their prices to push on those tariffs onto the consumers. Perhaps something Amazon isn't allowing them to do, but there will still be a ripple effect, as we said, one way or another. And it's not just Amazon. In fact, we can see from Shein as well as Temu, they're anticipated to increase their prices after these very large tariffs of 145%. So even if you were someone who was on the side that maybe people will move away from Amazon to Temu, Shein, as well as many others that are very similar, it looks like they will also be increasing their prices. So maybe it isn't a bad thing for Amazon, as prices overall will start to increase. It looks like perhaps the burden will be on the consumers. And we can see perhaps a famous electronics company, which is China-based, Anker, they have started to raise their price on Amazon, something we're not going to be surprised if we do see many companies start to lift those prices. And perhaps you've seen it as a consumer, if you are looking at products, maybe they have started to increase them. But we have an article from the Wall Street Journal from just 2 days ago, where they go on to say that Amazon is actually better prepared for this trade war than investors think, and they put this down to the size and the global reach that they do have in order to flex their muscles, and that shareholders perhaps shouldn't be worried, and maybe a great opportunity for longer term investors. So if we just try to digest this article just a little bit to understand the angle that it's coming from, it starts off by saying for Amazon.com, it has many businesses, something we will show you in terms of the different income streams. They have a cloud computing operation, they have Amazon Prime, the streaming platform, as well as their online retail business with a globe spanning supply chain, as well as hundreds of millions of customers, which in essence does give them flexibility and resilience amid fast moving markets as well as economic challenges. And that even though we can in fact note here the 145% tariffs on the imports that we talked about, 25% of the products that Amazon directly sell originate from China, but in essence their global logistics network let it shift its inventory and suppliers better than most of their competitors, which does give them that edge. There are also other things to consider with the company and the implications of these tariffs, and essentially because of the company and their large logistic footprint, this gives them leverage to negotiate with suppliers, whether that's to pre-buy inventory and control pricing, and potentially gain market share as some of their rivals do struggle. And as we said, right now, if you do want to take a look at the forward earnings, we've highlighted around the 26 times. Its premium to the S&P 500 right now is the lowest it has been in a decade, and this 26 was sitting at 38 times just before tariffs, so it could be looked as a golden opportunity, maybe an opportunity of the decade for this company in particular. As we just mentioned, it does believe that there is already effectively stress baked into the current trading price, and some of their competitors who perhaps are also equally affected by these tariffs, if not more vulnerable, haven't seen as much of a suppression on their share price. They go on to talk about the company's multiple trading at a 23% discount to that of Walmart, but ultimately you do have to consider other small to medium businesses which do sell their products on Amazon. In fact, we can note here more than 60% of goods that are sold on Amazon.com are from third-party vendors, and they're going to be the ones that in fact don't have the large margins, as we can see and mentioned earlier, to absorb their higher costs, and therefore they could in fact go out of business. And why this is an issue for the company? Well, look, just last year they drew in around 156 billion from charging fees to these vendors. So there is quite a lot to digest, and Morgan Stanley have effectively said if prices rises and we see sales decelerate down to these tariffs, they anticipate their earnings growth to slow down to 6%, where it was 11% last year, and ultimately will affect their bottom line and take a large chunk from their profit. Now, as we typically like to do on this channel, see what super investors are doing. Are they buying or are they selling? Well, we don't have that many that have come through for Q1 just yet, but as always on this channel, when they do drip in, we will highlight them, especially the likes of Warren Buffett, Bill Ackman, Bill Gates, and many others, so make sure you are subscribed. But one thing we have noted from the ones that have trickled in through, we noticed Hillman Value Fund selling 100% of their total position. In fact, it did incorporate 3.5% of their whole portfolio, as well as others that have started to trim, something we've just noted. But again, when we get more super investors, we may be able to identify a trend. But from the latest quarter, we can see Amazon is one of those that many super investors hold. In fact, it makes the top 5 position, where 25 of them do have some portion of this company in their total portfolio. Now, we can do the same with institutions. They hold 72% of the company. They sold 46 billion over the last year, but they bought a significant amount more at 137 billion. So they are obviously a lot more bullish than they are bearish. But we can also highlight in the most recent quarter, they bought a lot more shares than they sold, just under 7 billion worth of buying with 524 million worth of sales. Again, they do look to be a lot more bullish than they are bearish. And if we do the same analysis with insiders, they hold around 11% ownership. They sold around 2.5 billion worth of shares over the last year. No buying. Now, what we would typically say, insider selling, not necessarily a bearish signal. They sell for many reasons, personal and financial. In Q2, so just April alone, 470,000 worth of shares sold. In Q1, $23 million. So we can show you who these insiders are, but as we said, not a typical signal for us one way or another. Most recent, we have the CEO on the 1st of April, so a few weeks ago, selling 2,500 shares, netting them $470,000. Again, information is here if you want to incorporate it into your own analysis. Now, we already looked at the valuation in comparison against the sector, but if we do the same for the growth grade, they get an A-. Year on year, up 11% for their revenue, moving forward around 10%. Now, that's well above the sector median at the low single digit, but we can see over the last 5 years, they have been growing their revenue at a faster rate, 19 and 17% respectively, with EPS anticipated to grow over the next 3 to 5 years, 20%, again well above the sector at 11%, so yes, they do deserve a premium, but slower than they have done over the last 5 years at 31%. Now, if we do the same thing for the profitability, where they get an A+, gross margin 49%, that is above the sector at 39%, also above their 5-year at 44%. Bottom line, 9.3%, again above sector as well as their 5-year at the 4 to 5% level. So actually we're noticing efficiencies, not just revenue increasing year on year, but also improvements to their margin. And cash from operations, 116 billion, nearly double what we have seen on average over the last 5 years at 65 billion, and significantly above the sector at 273 million. Now, we've talked a lot about the company, but we also want to highlight their underlying metrics. As always on the channel, we'll focus on free cash flow as opposed to earnings, which is susceptible to manipulation by management through accounting. We want free cash flow consistent increases over the longer term, something we've pretty much noted year on year and anticipated to grow over the next 12 months to $4.79. In terms of sales growth, well, every single year, or we should say in fact 9 of the last 10 years, they have grown their top line at a double-digit rate. Most recent year, 11%, but remember, Morgan Stanley believe this could drop to the mid-single digit if we do see these tariffs continue and these geopolitical tensions continue to rise. Now, total sales over the last 10 years has been growing, in fact, more than 6 times from 2015's 107 to 2024's 638 billion. but we do have to point out they have been diluting your position as a shareholder over the last 10 years. Whilst we like to see this reduce, in essence returning excess cash to investor pockets, we do notice the opposite effect. One thing we would say though is if they continue to outperform the S&P, then this probably isn't an issue. Now ROIC, we love this metric, 10% or more. Give us faith, Mandarin are able to effectively allocate their capital. Very inconsistent, bear that in mind, but nice to see 12% in 2024, a continual increase from the lows at 3% in 2022. And then if you remember on the margins, we want to see efficiencies here increasing over time, something we get on the operating side, 2% 10 years ago, now at 11, and the free cash flow pretty much straddling around the 5% year on year, something we do want to see at a bare minimum. Then we move on to the final metric here, the net debt to EBITDA. Remember, this correlates to balance sheet strength, and these are the number of years it would take them to pay off all of their debt net of cash on hand. 0.34 on a trailing 12 month, expected to go lower over the next year at 0.3, so very clear to see their balance sheet is very, very strong, although we will highlight this shortly as well. Now, as we said, we will show their latest earnings where revenue was up 10% year on year. We also noted efficiencies to their margins, gross profit up 2 percentage points, operating up 4, and their bottom line up 4 percentage points as well. And then we move on to their growth in their individual income streams, and what we want to highlight, in fact, is their fastest growing stream, AWS, up 19% year on year, with advertising a close second at 18%, both of which do make up a vast chunk of their total revenue, but actually the majority does sit at those online stores, Amazon.com, which was up 7% year on year, and probably the one that will be most affected by these ongoing tariffs. And if we look over the next 4 quarters, they do anticipate growth to their EPS quarter by quarter, and we do like the fact that over the last 4, they have massively outperformed analyst targets, giving them a 100% track record. If you were to look at December 2026 based on the EPS, and you did want to use the forward P, based on those numbers, they would be trading at around a 22.9 level. Now, as we said, AWS was their fastest growing income stream. In fact, in 2024 alone, on average, it sits around the 18%. So that is very strong to see, although we can notice a bit of a slowdown from the highs from just a few years ago, but it continues to grow very strong as we just saw, as well as that being reflected on their operating income. And also worth noting, they do have the largest global market share, sitting at 30%, with Microsoft Azure at second, 21%, and Google Cloud at 12%. And for those that have watched our Google episode from just a few days ago, you will note that actually Google Cloud not only had a very large acquisition of Wiz Security, but also they are the fastest growing in this space. But nice to note, the space as a whole has been growing at 22% year on year. And as we said, their advertising was a close second at 18% year on year. And we can see that Amazon ads in the orange has been growing fairly strong over the longer term. But we do understand in this space, it is one of the smaller fish, so to speak, but nonetheless very profitable. The other element to note is their subscriptions up 10% year on year, which is included within that Amazon Prime. And if we were to take a look at streaming in terms of percentage in the US, then Amazon Prime a few years ago was sitting at 2.9, and whilst it has increased around 3.5% in just the latest quarter, we can in fact note in terms of that Netflix and in fact YouTube itself does come in at a higher element, but you could argue this does mean there is a lot of room for growth and taking some of market share from whether that's Netflix or any other competitors. The most interesting thing perhaps about the company is that they continue to spend a lot of money year on year, high capital expenditures, with FY25 anticipated to be 100 billion. In fact, quite consistently they've been up there as the company that spends the most, and the CEO went on to say for the full year 2025 they're expecting 100 billion expenditure because they believe that artificial intelligence is now giving them a once-in-a-lifetime opportunity, so it will be interesting to see how this translates to shareholder return. Now, for those that are interested to see how they formed against others in the industry, we have Alibaba, PDD Holdings, as well as some very well-known other companies. Now, over the last year, they are in fact down 5%, one of the worst performing. In fact, when you've got companies like Alibaba up 62%, Mercado Libre up 50%, as well as JD up 42%. However, if we were to expand it to over the last 5 years, they are up around 45%, sitting in the mid-performance of these companies. Yet over the last 10, they have performed fairly strongly, up 676%. As we say though, past performance is not an indicator of the future. They could perform a lot better over the next 10. They could in fact perform a lot worse. And for those that like to look at it against the S&P, they've underperformed over the last year, down 5%, S&P up 5. Over the last 5 years, they've underperformed as well, up 45%, S&P up 84. But when we do zoom out, over the last 10 years, they've massively outperformed 676, the S&P 150. But give us your thoughts. Do you believe over the longer term, Amazon can continue its outperformance against the S&P? Because if you don't truly believe this, you're better off considering an ETF that perhaps tracks the S&P like Vogue. The other thing we wanted to highlight, not just their top line revenue, which has grown astronomically, in fact more than 6 times and fairly consistently over the last 10 years, but we want to understand, what does the bottom line net income tell us? Does it give us a fairly consistent story to what we just noted above? And the answer for the large part is yes. We do get that increase, going from 600 million in 2015 to now sitting at just under 60 billion. So growth has been strong, and we do anticipate this to continue, both top line as well as their bottom line. And as we always like to do, a very quick health check of the company, total cash versus total debt, with their cash increasing, going from 20 billion 10 years ago, now sitting at just over 100 billion. And if you remember, they're anticipating around a 100 billion capital expenditure this year. As we mentioned, a once in a lifetime opportunity, the words from the CEO. But as always, we do like to compare the cash against their total debt, because one number here in pure isolation isn't going to give anything away. So we look at the total debt numerically and directionally, which, like cash, has increased over time, going from 18 billion in 2015 to now sitting at 155 billion, actually superior than their cash balance at 100 billion. But we saw net debt to EBITDA sitting around 0.3. So for the time being, it does look like the balance sheet is very strong. But as always, something we will analyze on this channel on a quarter by quarter basis, year on year. So make sure you are subscribed. The other thing we can point out from their latest investor presentation is that when we look at their net sales on a trailing 12 month, they're up 11% year on year. The large portion of their revenue is in fact coming from North America at 61%. Their operating income also increasing at a very rapid rate, in fact up 86% from the same quarter last year. And that's also reflective when we look at their bottom line. That in itself is up 95%. And just before we go on to the valuation, we do want to let you know we have released our latest free weekly article. We draw on every single Monday morning, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 severely undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of the stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic value in today's episode gets to $230, derived from the DCF model. Now, we'll show you the makeup of this. We have the free cash flow year on year, including 2024. Average growth, negative 34%. It is skewed given we have gone from negative to positive for a number of years. But moving forwards, we've gone 20%, where we do in fact have a low, medium and high, 20, 25, 30. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether that's for Amazon or any others. But based on 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, get to our intrinsic value at $230, which, as we can see, gives 34% upside. Now, this is actually lower than analyst expectations, but for those that believe it should be higher at 25%, $325, 89% upside. And for those that believe they will really be able to crack on at 30%, 454, indicating 164%, more than a double. Now, we want to be conservative today and go at the 20% point, but we're not just done there, because we always like to add an MOS, where we kick off at 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $207, then we keep going till it's near the current trading price. And in essence, we're saying it's not at a 30% MOS just yet, but you are getting bang on 25% for a Mag 7 high quality company. But you could argue it isn't tariff proof, it isn't recession proof if we do end up in one, so maybe you want a little bit more, or maybe 25 is sufficient. Wall Street themselves, they see this at $254 over the next year. translating to 48% upside, and as we saw, a double strong buy rating and a buy rating, making it one perhaps to consider in the portfolio. But as always, give us your thoughts. Amazon, buy, hold or sell, and we'll show you for those that want it at 30%, a buy at 161 and 35 around 150, and we'll also show you for those that believe 20% is in fact too high. If you wanted to see around 15% in the model, you would be looking intrinsically at $161, so it would be overvalued at this point. Again, if you grab a copy of this model, you can run through your own numbers, and we'll show you at the 18% point just under $200. So perhaps if you believe somewhere between 15 to 20 at the 18% point, and you wanted to see is there a margin of safety, you are getting at least 10% up to 180, 15% around that point. So for those, as we said, want to be a bit more conservative at 18% growth rate, you are getting a 15% MOS. Wall Street, as we said, still very bullish, 48% upside. Do you see this as a buy, hold or sell? And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.